Rates just got repriced, and gold refusing to sell off is the tell that the bond market is the one blinking, not the other way around, because the old playbook says higher yields should kneecap gold. Yet here we are, watching rates jump around on every macro headline while gold just holds its ground. And that's not mystery strength, that's structure, that's positioning. That's a market quietly admitting something the mainstream narrative still can't say out loud. And later in this video, I said I'm going to give you the exact scoreboard for the next 1 to 2 weeks, what levels matter, what confirms this, what breaks it, and the one hidden detail that explains why gold didn't flinch when rates moved. First, let's get the tape straight, because most people are arguing from vibes. Rates repriced is a dramatic phrase, but it usually hides the important question. Repriced how? The front end can reprice because traders think the Fed stays tighter for longer. The long end can reprice because inflation expectations drift. Or the long end can reprice because the market demands more compensation just to hold duration, term premium. Those are 3 different beasts. They hit portfolios differently, and gold reacts differently to each. That's where the real pressure starts. Now look at what you've actually seen recently. Gold has been pushing the upper end of its recent range, strong enough that every dip feels like it runs into a buyer who doesn't care about your intraday macro take. Meanwhile, the 10-year yield has been lurching, up on strong data, up on sticky inflation, up on policy uncertainty, and sometimes up even when risk assets look wobbly. That combination is the whole story. Because when yields rise for good reasons, growth optimism, confidence, real rates ripping, gold usually flinches. When yields rise for less good reasons, risk premium, uncertainty, funding stress, credibility questions, gold can hold or even strengthen. But that's not the part most people watch. Most commentary treats yields like a single number with a single meaning. It's lazy, and it's exactly how you get trapped right now. Because this move isn't emotion, it's math, it's decomposition, it's who is forced to hedge and why. And if you miss that, you'll do the classic thing retail gets trained to do. You'll panic sell the wrong dip, then chase the wrong breakout, then swear the market is manipulated, when it was just structure the whole time. But there's a cleaner way through it, because if this one mechanism is what's driving the non-flinch, the next week is going to be very different from what most people expect. So let's define rates repriced in a way that actually matters. A nominal yield is not one thing. It's roughly real yield plus expected inflation, plus a shifting premium for uncertainty and supply demand in the bond market. That last part, term premium, is the sneaky one. Because term premium can rise even if growth is not improving. It can rise because the Treasury has to fund. It can rise because the market needs more compensation to warehouse duration risk. It can rise because volatility in rates increases and dealers demand more spread. It's not a good news rate move, it's a risk price rate move. And here's the hidden detail most people miss. A yield move that looks huge on a headline can be a very different cocktail underneath. If the real yield component isn't exploding higher the way the headline suggests, gold doesn't have to flinch. If inflation expectations are moving too, gold doesn't have to flinch. If the dollar doesn't confirm the move, gold doesn't have to flinch. And if there's a steady structural bid underneath gold that isn't price sensitive, official sector buying, reserve reallocation, strategic hedging, then yields can do a little dance on the screen while gold just keeps its footing. That's the reframe. And the next detail is what flips the whole setup, because gold trades in 2 worlds at once. One is the paper world. Futures, options, leveraged positioning, headline-driven flows. That world sets the screen price minute to minute. The other is the physical and funding world, the cost to finance metal, the willingness to lend it, the demand to hold it outright when trust in paper claims gets questioned. That world doesn't care about your 5-minute chart. It cares about settlement, collateral, and insurance. And when those 2 worlds start to disagree, when paper gets pushed around but physical demand and reserve behavior stay firm, you get exactly what you are seeing now. Gold refuses to behave the way the rates up, gold down crowd expects. But that's not even the best part. Let me simplify a key mechanism without turning this into a textbook. When you buy gold via futures, you're engaging with a contract that has a carry structure. There's an implied financing rate in that curve. In calm times, the curve structure, whether it's in contango or backwardation, reflects storage, financing, and convenience yield. In stressed times, the curve can start whispering uncomfortable truths. If financing tightens, if metal availability matters, if the willingness to part with physical changes, the paper price can become less authoritative than the signals around it. You'll see it in spreads, you'll see it in lease rates, you'll see it in the way dips get absorbed fast, even when macro headlines scream rates up. And that's where the real pressure starts. Now stack the proof. Not one argument, 5+. Because markets don't move for one reason. They move because multiple forces align, and then reflexivity takes over. Proof point 1, real yields versus break-evens, the mix. If real yields were truly ripping higher cleanly, with inflation expectations anchored, gold should feel weight. Not always instantly, but the relationship tends to show up. So the first check isn't your favorite talking head yelling 10-year up. The first check is, what did real yields do? What did inflation expectations do? If nominal yields rise because the inflation component is rising, gold can hold because gold is, at its core, a monetary asset that prices long-run purchasing power uncertainty. If nominal yields rise because term premium rises, because the market demands more compensation to hold bonds, gold can also hold because that's not a confidence signal. That's a risk premium signal. And a risk premium signal is exactly the kind of environment where gold stops acting like a simple anti-yield trade. Proof point 2, the curve shape matters more than the headline print. When the front end reprices, when traders push out expected rate cuts or price and stickier policy, that can hit risk assets, sure. But gold isn't just a risk asset. It's a hedge against policy error and monetary credibility. If the curve is telling you policy stays tight, while the long end is also demanding more compensation, that's not a clean growth is great story. That's a story of uncertainty. And uncertainty is gasoline for hedging demand, but that's not the part that matters. The part that matters is what the curve shape forces real money to do. Funds with duration exposure start hedging, risk parity starts adjusting, macro portfolios start balancing. If rates volatility rises, the hedging cost rises, which forces position changes. That kind of mechanical flow can drive yields higher even as confidence is not improving. And if that's the regime, gold's non-flinch is not surprising. It's rational. Proof point 3, the dollar's behavior. A rate move that should strengthen the dollar but doesn't, that's a giant flashing sign. Because the classic channel for rates up hurts gold often runs through a stronger dollar and higher real yields. If the dollar doesn't rip higher with yields, you're missing a crucial confirmation. That can happen for a few reasons. One is that global investors look at higher yields and think that's compensation for risk, not return, and they don't chase the currency the way they used to. Another is that hedged foreign buyers of treasuries don't get the same benefit. Another is that the narrative is shifting from U.S. exceptionalism to U.S. funding reality. You don't need a conspiracy, you just need incentives. If the move in yields is being read as a risk premium, the dollar can fail to confirm even when yields rise. And when the dollar fails to confirm, gold doesn't have to flinch. It can look almost boring. Until it isn't. Proof point 4, the official sector bid, the quiet gravity. This is the one that a lot of people still underestimate because it doesn't show up in your daily feed the same way an ETF headline does. Central banks and sovereign actors have been treating gold less like a trade and more like reserve collateral in a fragmented world. Call it de-risking, call it diversification, call it sanctions awareness, call it we don't want all our reserves in someone else's liability. The label doesn't matter. The mechanism does. When that bid is active, gold becomes less sensitive to short-term rate noise because it assists being accumulated for reasons that aren't TFBOs. Price elastic in the same way. That's not a guarantee of straight-up movement, but it changes the baseline. It changes what dip buying looks like. It changes who is on the other side of paper selling. And that's where the real pressure starts. Proof point 5, visible flows and the way dips behave. Even if you don't want to over-rely on ETF flows, you can watch behavior. Do pullbacks get bought quickly? Do you see that rubber band effect where price drops on a rates headline and then snaps back before the day is done? That's a footprint. That's evidence of a bid that isn't waiting for permission from the bond market. And if the bid is there while rate volatility is rising, you get a market that feels like it's floating. That's when people call it manipulation. It's not. It's just that someone bigger is leaning the other way and they have a longer clock. Proof point 6, positioning and reflexivity. How forced flows can take over. This is the part most people feel but can't explain. When the market is positioned one way and a key level breaks, the next move isn't just new buyers. It's forced buying, shorts covering, dealers hedging, trend systems flipping. You don't need everyone to believe. You just need enough people to be wrong in the same direction at the same time. And then the market stops asking for permission. But that's not the part that matters. The part that matters is that gold-esque non-flinch through a rate. Repricing tells you something about the balance of power between discretionary narrative and mechanical flow. When gold refuses to sell off into rates up headlines, it suggests the selling pressure is being absorbed. Absorption changes everything. Absorption means supply is being met without needing a much lower price. Absorption is what precedes the moves that feel like they came out of nowhere. And that's where the real pressure starts. Now we talk calendar. Because why now isn't just macro, it's timing. Markets have rhythms, liquidity changes, hedging deadlines show up. And this week and this month have a few structural triggers that matter even if you don't care about the political soap opera. You've had thin liquidity moments, Holiday effects, risk desks cautious, the kind of tape where a single headline can punch price through levels it shouldn't or not to break. You'd have got a policy decision window looming where traders done 8T want to be naked into a surprise. You've got options cycles that quietly change the hedging flow, and you've got month-end behavior that forces rebalancing. None of these guarantee direction, but they amplify whatever underlying mechanism is already present. And if the underlying mechanism is gold has a structural bid while rates volatility is rising, then thin liquidity and hedging deadlines can make the next move sharper than people expect. Because if this one level breaks, the math changes. Let yes address the mainstream explanation you've probably heard. Gold is just reacting to geopolitics, or gold is just a risk hedge, or gold is just an inflation hedge. Each of those is incomplete. Gold is a hedge, yes, but against a specific kind of risk. The risk that paper claims Don T behave the way the model says they should when the world gets messy. Gold isn't just inflation. Sometimes inflation is high and gold is flat. Sometimes inflation is falling and gold rises. It's not a simple one-factor trade. It's a monetary asset that responds to real yields, currency confidence, liquidity conditions, and the desire for collateral that isn't someone else's promise. So here S, the full reveal of the hidden detail. Gold didn't flinch because the market is treating gold less like an anti-yield trade and more like insurance on credibility and reserve safety. At the same time that the rate move looks more like a repricing of risk premium than a clean surge in real returns. That's why the old relationship feels weaker. That's why the headline doesn't match the tape. And that's why you need a scoreboard instead of a story. Now let's translate that into who is forced to do what, because that's where price discovery actually happens. When rate volatility rises, bond traders hedge more aggressively. That can push yields around in ways that look like repricing, even when the underlying growth story hasn't CRT changed much. Dealers managing their books change how they quote liquidity. Funds exposed to duration risk adjust, often into month end, and those flows can be mechanical, not emotional. Meanwhile, if gold is being accumulated as reserve collateral or strategic hedge, that bid doesn't care if the 10-year is up 10 basis points today. It cares about the next 12 months of trust. So paper sellers can hit it, but they find buyers. And when sellers don't get follow-through, they get tired. Then they cover. Then the market starts to lift. Now we get practical. What comes next? You need two scenarios, not one. Because if you're serious about trust and risk management, you don't marry a single path. You map the branch points. Scenario one is the controlled pullback and retest. In this scenario, gold cools off, maybe because yields spike again on a data print, maybe because the dollar catches a bid briefly, maybe because risk assets wobble and people delever. Gold pulls back toward a prior breakout zone, call it the most recent consolidation area, and it holds. It doesn't need to rip immediately. It just needs to stop going down fast. You'll see it in the tape. Sellers push, but they can't accelerate. Volatility might pop, but then compress. That's the market building a floor. Confirmation in this scenario is boring price action. Higher lows, quick recoveries, and the absence of panic follow-through on bad for gold headlines. The next detail is what flips the whole setup. In this scenario, what invalidates the thesis isn't a random wick, it's a failure of behavior. If gold starts reacting like the old model again, if real yields jump higher cleanly, the dollar strengthens with it, and gold breaks below key support and stays there with heavy volume and no snapback. Then the non-flinch was just a pause, not a signal. Invalidation looks like the market stops buying dips and selling starts to cascade. That's when you step back and reassess because the mechanism changed. Scenario 2 is continuation squeeze and gap risk. In this scenario, gold doesn't give you the polite retest. It grinds, then jumps. You get a day where yields do something that should hurt gold, and gold goes up anyway. That's when shorts get nervous. That's when hedges chase. That's when the move becomes reflexive. The catalyst can be a policy surprise, a volatility spike in rates, or simply the market realizing that the dip buyers aren't leaving. In this scenario, the risk is that you keep waiting for the perfect entry and the market just doesn't offer it. That's not bullish poetry. That's mechanics. If positioning is wrong and liquidity is thin, the path can be air pockets upward. And that's where the real pressure starts. Now, levels. I'm not going to pretend I can hand you magic numbers that work forever, but you can set a framework with real reference points. First, identify the recent high zone, the area where price has repeatedly stalled or accelerated. If gold is pressing into that upper range and keeps closing strong, that's confirmation of strength. Second, identify the last clear consolidation, where price spent time before breaking higher. That zone becomes your line in the sand for the controlled pullback scenario. If price returns there and holds, the trend structure is intact. If it slices through and can't reclaim it, that's a warning the tape is changing. And don't just watch gold. Watch the trio that tells you whether this is a credibility hedge regime: real yields, the dollar, and rates volatility. If real yields rise and gold refuses to break, that's strength. If the dollar strengthens and gold still holds, that's strength. If rates volatility jumps and gold catches a bid, that's the insurance bid showing itself. But if real yields rise cleanly, the dollar rallies, and gold finally starts behaving like a simple anti-yield trade again, then the story shifts. Because if this one mechanism fades, the math changes. Now the psychology shield. This is where most people lose money even when they're directionally right. Volatility is not random. It's a weaponized environment that triggers predictable mistakes. The market will give you a scary down candle on a scary headline, right at the moment your brain is most certain the thesis is dead. Then it will reverse. Or it will give you a euphoric green candle that makes you feel late, right before it pulls back. The goal is to make you trade your emotions instead of your plan. So here's the shield. Separate trend signal from noise. Noise is intraday reaction to headlines that doesn't change the underlying structure. Trend signal is behavior around key zones and confirmation across the scoreboard. If price breaks a support zone intraday but reclaims it by the close and keeps forming higher lows, that's noise trying to scare you. If price breaks a zone, fails to reclaim, and then sellers accelerate with confirmation in real yields in the dollar, that's signal. You don't need to predict. You need to categorize. Second, size your conviction like an adult. If you're all in on a single macro take, you're not investing. You're gambling on your ego. In a regime where rates and gold can decouple, the whipsaws get nastier. You can be right on the thesis and still get chopped up if you overleverage or overtrade. Price can whip around violently, even if the thesis is correct. That's not a warning to be timid. That's a warning to be structured. Third, stop letting one indicator hypnotize you. The 10-year yield is not a commandment. It's an input. The relationship between yields and gold changes with regime. In some regimes, gold is the anti-yield trade. In other regimes, gold is the anti-credibility hedge. In other regimes, gold is a liquidity hedge. Your job is to recognize which regime you're in by watching behavior, not by repeating an old correlation like it's physics. Now, what to watch next for the next 1 to 2 weeks? This is your scoreboard. No fluff, no vibes. Watch real yields versus inflation expectations. If nominal yields rise, but real yields don't surge, gold has room to hold. If nominal yields rise because inflation expectations rise, gold can hold. If real yields surge cleanly higher and stay there, gold has a tougher headwind. That's point one. Watch the dollar, not the narrative about the dollar, the actual behavior. Does the dollar confirm higher yields with sustained strength? Or does it wobble, suggesting the yield move is risk premium, not return? If the dollar doesn't confirm, gold's non-flinch makes sense. If the dollar does confirm and gold still holds, that's even stronger. That's point two. Watch rates volatility and liquidity. If volatility rises into a policy window or month end, hedging flows intensify. That can create weird cross-asset moves. If gold catches bids during those stress pulses, it's telling you the market still wants insurance. That's point three. Watch the gold tape around the prior consolidation zone. Does it hold on pullbacks? Does it reclaim quickly after dips? Are sellers getting follow-through or getting absorbed? Absorption is the tell. That's point four. Watch positioning and forced behavior cues. You don't need exact numbers to feel it. You can see it in how breakouts behave. In a healthy squeeze setup, breakouts don't immediately fail. Pullbacks don't expand into cascades. The market feels supported even when the headline flow is mixed. That's point five. And here is the one metric that everyone should have tattooed on their brain in this regime. Confirmation across the scoreboard, not confirmation from a single headline. The market is a machine. It responds to constraints. Funding, hedging, reserve decisions, liquidity. If you're only consuming stories, you'll always be late. If you're watching constraints, you'll see the move before it becomes obvious. Now, I want to address the skeptics, the people who say gold's move is fake, or it's just retail hype, or it's all manipulation. I get the impulse. When a market breaks an old relationship, it feels unnatural. But the simpler explanation is almost always structure. A market can be structurally bid without being rigged. A market can ignore a headline because bigger players are executing a different mandate. A market can decouple because the regime changed. If you want a finance-literate explanation you can stand on, it's this. The bond market repricing is not a clean signal of higher real returns. It's a messy repricing of risk, policy path uncertainty, and funding reality. In that environment, gold becomes less of a yield competitor and more of a credibility and collateral asset. So gold doesn't flinch, not because it's magical, because it's doing its job. So how do you use this without turning it into a reckless gamble? You stay flexible. You keep the two-scenario lens. You let the market show you which branch you're in. If we get the controlled pullback, you want to see that consolidation zone hold. You want to see dips get bought. You want to see the scoreboard stay supportive. Real yields not ripping uncontrollably higher, the dollar not exploding, and gold reclaiming closes above key areas. That's your base case confirmation. If we get continuation squeeze, you want to see breakouts hold and pullbacks stay shallow. You want to see that bad news can't push it down behavior. That's when the market is telling you supply is exhausted. That's when forced buying can kick in, but that's also when gap risk rises. And gap risk is where people get emotionally manipulated. Because when a move is reflexive, it feels safe right before it punishes late chasers. So you respect volatility. You don't let excitement become leverage. And here is your subtle but important reminder. You do not need to predict the next tick to be on the right side of the regime. You need to watch whether the non-flinch persists. Because if gold keeps refusing to obey the old rates up, gold down script, the market is telling you something deeper is happening. And that's the part most people won't understand until it's already priced. One last thing, this is the community edge. If you're the kind of investor who needs certainty before acting, you'll always buy after the easy part is over. If you're the kind of investor who can hold two scenarios in your head, watch the scoreboard, and stay calm through the noise, you're playing the game the way professionals do. Not because you're smarter, because you're structured. And that structure protects you from the single biggest enemy in markets, your own reflex. So here's your final checklist for the next couple weeks. Watch the real yields versus break-evens mix. Watch the dollar's confirmation or lack of it. Watch rates volatility around policy and calendar windows. Watch the tape for absorption at the prior consolidation zone. And watch whether bad news fails to push gold down. If those stay aligned, the non-flinch isn't a curiosity, it's a signal. And if you want to keep sharpening this kind of thinking, mechanism first, narrative second, stick around. Not because you need another hot take, because in markets like this, the only edge that survives is the ability to stay rational while everyone else is getting emotionally traded by the tape.